Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single family homes all the way up to 600 plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. But before I do that, I want to wish you a very happy Thanksgiving. Yeah, I hope you're having a wonderful day. I hope that you are surrounded by the people that you love, enjoying doing the things that you enjoy doing. Maybe that's cooking the turkey. Maybe that's watching the Lions lose again on Thanksgiving. Whatever it is, I'm just glad that we've made it mostly through 2021, and we've made it to Thanksgiving. So I want to wish you and your family a happy Thanksgiving, and I hope the tryptophan coma, it's whatever's in the turkey meat that's supposed to make you go, yeah. I hope that coma, when it hits you, I hope it puts you in a very nice slumber, and I just want you to enjoy the day. Now, let's start working on that financial freedom, shall we? Well, how should we do that? I mean, it's Turkey Day. We're supposed to not be focused on the things of the world. As a matter of fact, we're supposed to just be thankful. We're supposed to be thankful for our country. We're supposed to be thankful for our families. We're supposed to be thankful for the fact that we live in the greatest country on this planet. We absolutely do. And even though this country is not perfect, it is not perfect by any stretch of the imagination, it is still the best country on this planet. And if you don't think so, not a problem. Pack your gear, move to the country you think is better, live there for a year, and after a year, you can put your head between your legs and come on back. We'll let you come on back. It's not a problem. All right. Financial freedom, though. Financial freedom. I'm supposed to be working on your financial freedom while you're watching football, eating turkey, and having me on in the background. So, what could I tell you that might grab your attention? What could I say to you on a day like today that would make you stop what you're doing and listen to me? Well, I'll be honest with you. I've got a lot of things to share with you. The first thing I want to share with you had to do with something that occurred in October. Yeah, I'm going to go back about 6 weeks because in case you missed it, GlobeStreet.com published an article that said there is a severe shortage of rental housing at every price point now. You might have missed that. Apartment vacancies as of October hit a historic low, declining to like 2.7%. And that was the fourth consecutive month where vacancy rates were actually declining. What does that mean? It means that apartment units that you may have in your inventory are being filled up. And why is that a good thing? Because when an apartment is occupied, it is occupied by somebody that has entered into a business relationship with you to provide clean, functional workforce housing. And they're willing to pay you every month a certain amount of pre-negotiated money to you each and every month to live in that space. See, when an apartment unit is vacant, it doesn't pay you anything. It absolutely pays you nothing. And no matter what's going on in the economy right now, one of the things that's very clear is that the vacancy rates are going down. That means if there's a shortage of rental housing at every price point now, what's going to happen in the marketplace? Well, the first thing that tends to happen is that the owners of those places, those apartment units, might take a look at their business plan and they might say, If we were getting $1,000 a month for that particular unit, and as soon as we put that apartment on the market, it's gone. It's gone. What should we do to maybe affect our bottom line? Well, the first thing that comes to mind is raise the rent. Yeah, raise the rent. If people are clamoring for your product at $1,000 a month, maybe if you raise it to $1,050, it might move some people out of the way. Some people may say, no, that's too expensive. That's not what I'm willing to pay. But I would also think in the very same breath, there are people that would say, I'm willing to go an extra $50 for that particular unit. I will go $50 extra every month. And what that would do for you is that would increase your revenue streams by $600 a year. Now, it doesn't sound like a whole lot of money, does it? $600 per year. But in the bigger scheme of things, if you consider that maybe that one particular apartment unit is one of, say, 100 units, well, if we put 2 zeros behind that $600, what does that do for us? Well, that actually increases our revenue streams by $60,000. And we didn't have to do anything materially to the property in order to drive the rents up. And we weren't coercing anybody into paying additional rents. We merely put the property on the market, offered it for a slightly higher price point, and people came along, investigated the property, investigated the terms of the lease, and said, let's do this. Let's do this. I want to rent from you. This is what goes on in real estate. And this is one of the reasons that real estate is completely different than what you're doing in the stock market. Because what you're doing in the stock market is you're just taking your money. Actually, you're not even doing anything with your money. It's all being done for you. It's being taken out of your check before you even see it. And then a money manager is managing it for you, right? And it must be okay because the stock market is doing wonderfully. Well, when we come back from the break, I've got some more information to share with you. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. All right, I've got a little piece of information that I want to share with you. This also came from globestreet.com, specifically from an author by the name of Lynn Pollock. And one of the things Lynn pointed out in the article is that new lease demand in the year that ended September 2021 also increased by 50.5%, with apartment resident retention surging to 58%. That number represents an all-time high according to data that was compiled from RealPage. Now, the reason I bring this up is if you were listening to the show on Tuesday, you heard John Boriak lay out his entire plan of action for how he owns and operates his apartment communities. Now, if you didn't catch that show and you want to listen to it, go to lifestylesunlimited.com. When you get there, click on the radio tab, and you will see all of our shows located there. Yeah, they're all converted into podcasts so that you can go back and listen to them. So you're looking for, last Tuesday's show. And ironically, John lays out everything. He lays everything out. Now, to the untrained ear, maybe you didn't hear his entire business plan. But as I was interviewing John, that's exactly what he did during the entire hour that I had him on the show. He laid out the business plan that he follows and operates. He talks about how his residents are so important. He talks about how his team is so important. This guy He's in the Gets It Club when it comes to owning and operating apartment communities. One of the things that John said, though, that may have slipped past you was the concept that you really start to make good money in apartment communities when you retain your residents. And some of you may have heard that, and you may have thought, I'm not sure what that means, but eventually Al will get around to explaining that to me. And you're right. I'm going to explain it to you right now. So what John was pointing out is that even though you do make money every month from every resident that is renting your apartment units, here's the thing. There are costs associated with doing what's called turns. In other words, when you prepared a unit to go into the marketplace, chances are if it's one of the units that you're rehabbing, this is the first time this unit has actually seen the marketplace in its current condition. So you've done a lot of things to really improve the marketability of that particular unit, to make it more competitive in the marketplace against other units, because people look at different places before they decide where to rent. When they secure a lease in your property and they move in, you make money every month. But at the end of the 12-month period, if your resident makes a decision to move out, it's going to create what's called a turn. In other words, that resident is going to leave at the end of their lease. They're going to be gone. And you're going to go into the unit and you're going to take a look at what needs to be done to bring that unit back to its luster. Yeah, believe it or not, properties have a tendency to wear out over time. The things in those properties tend to wear out over time also. As a result of that, you have to go in, you have to take a look at how much wear and tear has actually occurred. Now, after a year, there shouldn't be a whole lot of wear and tear, especially on granite if you had granite countertops. But maybe you've got carpeting. Maybe you need to take a look and see how that carpeting is wearing. Because if that carpeting is not wearing correctly, it may have an impact on your ability to market that property. So as a result, you may have to make a determination to either replace the carpeting or do something to restore its luster. Now, I'll tell you this, I don't have any carpeting in any of my properties. I just don't like carpeting in any of my properties. I believe other materials wear much better. And where did I learn all of that? Well, I learned that from Lifestyles Unlimited, of course. So if you're doing a turn on a property, there will be a calculation for cost associated with doing that turn. Maybe you need to pay a handyman for an hour or two's worth of labor in order to do the things that need to be done in the property to get it back up to speed. Maybe you need to do some repainting. Maybe you need to do some other things in the particular unit. I don't know what those things are. I'm just giving you an example. So when all of those renovations are done, when all of those things are done, the property is available and you'll lease it out. So here's the key thing. If you retain your residents, first of all, you don't have a break in the income stream. In other words, if they, at the end of their lease period, re-sign a lease, then basically everything continues as if it never stopped. The other thing that tends to happen is that there will be no cost associated with you having to do a turn on that particular unit because the resident stayed there. So when I see statistics that are telling me that resident retention surged to 58%, that is a huge number because, trust me, in the industry, people have a tendency to move about the country or move about the city or move about wherever. Yeah, not everybody stays in the same place. Sometimes people's housing requirements change. Maybe they have a child so that studio apartment, it's not working out so much anymore. Maybe they need a 1-bedroom apartment or possibly a 2-bedroom apartment now. Or maybe there's somebody that's been living in a 2-bedroom apartment and they've decided they want to go buy a house to live in. So they go buy a house to live in. So people move for a variety of reasons. And ironically, even though we're coming out of this pandemic, at least that's my version of the truth, I think we're still coming out of the pandemic. The fact that 58% of all of those individuals out there that rent have chosen to stay right where they're at, that's huge. That is actually huge. Now, another article that caught my eye was one that had to do with home prices. Yeah. So I'm going to switch my focus right now away from apartments, and I'm going to talk a little bit about single family properties. At the end of the day, these are the two modalities that we'll teach you about at Lifestyles Unlimited. We will teach you how to correctly invest in these two modalities of real estate investment. We teach only these two because we have found that these two are the most successful over time. And ironically, through the pandemic, everybody needed a place to live now, didn't they? When we come back from the break, I'm going to tell you what the Mortgage Bankers Association is predicting by late 2022. Stick around.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. All right, we're going to get into an article that Fortune magazine published. Was written by a gentleman by the name of Lance Lambert. And in this article, Lance is saying that home prices are expected to drop by late 2022. And that statement was made by the Mortgage Bankers Association. So, who is the Mortgage Bankers Association and why do they make these predictions? Well, the Mortgage Bankers Association is it's a big industry trade group, and they're based in Washington, D.C., and as the name implies, it's a trade group that has to do with people that offer mortgages. Yeah, Mortgage Bankers Association. I mean, it kind of makes sense, right? So they published a document not too long ago, and in that document, they state, now this is the Mortgage Bankers Association's prediction. Okay, this is their prediction. They foresee the median price of existing homes posting a year-over-year gain of about 15.3%. In other words, they're expecting the median, in other words, half prices are above, half the prices are below, the median price to get up to $362,000 next quarter as we get into 2022. It also sees pricing beginning to fall as the year progresses. Yeah, that's what they're predicting. So they're anticipating we're just going to keep ramping prices up. They're just going to keep ramping up. And then we're going to get to the first quarter of 2022. And possibly they predict the median price to fall a little bit. They're actually expecting it to go from $362,000 down to $352,000. So that's going to represent about a 2.5% year-over-year drop in home prices. So here's the thing I've got to ask you. Are you worried? Are you concerned? Is that the piercing of the so-called bubble that you've been hearing about? And I'm here to tell you, I don't think it is. I think what the Mortgage Bankers Association are seeing are the same things that we're seeing at Lifestyles Unlimited. We're seeing a society come out of a pandemic where we were told to hunker down, go nowhere. I mean, we were restricted. We were literally put on home arrest. The majority of us were put on home arrest. You remember that, right? And those of you that got to go out because you were essential workers, you didn't get to do much else than that either, right? Except go back home and maybe get some gasoline. Okay, and go to the supermarket. Okay, that was pretty much our existence, right? So people still moved about this country. They did. People moved from place to place. I was actually moving about this country in the middle of the pandemic, and I saw people moving around. Yeah, I wasn't the only one. Now, I will tell you, the streets were not as packed as they potentially could have been, but people were still moving about this country. Pricing pressure is coming from the fact that more and more people are emerging from this pandemic with a desire to secure real estate, to buy real estate. And as a result of that, and the fact that we have had one of the smallest supply pools of available housing on the market, I mean, it's a perfect storm event. When you have people that are demanding product and the product availability is not substantial enough to meet all of that demand, what you're going to find is that pricing pressure is going to move the price upward. So the Mortgage Bankers Association, I mean, they're thinking we're going to get to a median of about $362K. But not too long after that, it might drop off about $10,000 to a median of $352,000. So, again, I ask, are you worried about that? And I'll be honest with you, I'm not worried about that at all. Because even though they may have a lot of smart people hanging out in that organization, their crystal ball is as effective as my crystal ball is. Yeah. I mean, we can kind of read the tea leaves and we can kind of anticipate what's going on. And to be honest with you, I don't think they're too far off track. I think what we're going to see through 2022, at least this is kind of my thought. These are my thoughts, strictly Al's opinion. But I think they're right. I think we're going to continue to see these housing prices press upward through the end of the year. And it has to do with supply and demand. It has to do with the lack of qualified inventory out there. It has to do with a lot of things that are pushing pricing pressure upwards. I've already told you these things, haven't I? But here's what I haven't told you. I think we're going to get to a certain point, and I think we're going to see some of the constraints in the marketplace kind of back away. I think that demand for housing, or houses, I should say, I think it's going to still be there. But I also think that more and more people, as we emerge from the pandemic, are going to be less afraid of selling their principal residence. Yeah. Now, I will tell you, there are people out there that didn't put their properties on the market because they saw the craziness of the market. Yeah, they didn't want to be a part of the fact that even though they could sell their property today and get multiple offers on it, if they still wanted to own a property, what they would have to do is get into the other side of the market, which is the craziness of a buying. I mean, I went through this year. I went through that process. And I will tell you, I was not afraid of it, but it was not the most comfortable transactional process I've ever been through. No, because the market is wonky. But here's the point I want to make to you. I think that prices are going to kind of level off. I think they're going to hit a peak. Now, the mortgage bankers seem to think that maybe they'll dip back down. I don't necessarily know that that's going to happen. I mean, this is not the stock market. It's not like, pricing goes up, and then people sell, and then all of a sudden you get a little bounce and it kind of levels off. No, real estate is completely different. And here's the other thing I need to point out to you. The Mortgage Bankers Association, they're making a very broad brush representation of the country. Yeah, they're making a huge representation with what they think is going to happen across the entire country. And I'm not saying they're wrong. I'm not saying they're wrong. But I would tell you this. Real estate tends to be local. Real estate tends to be local. Ask Zillow about that. Yeah, as a matter of fact, one of the articles I've got today comes from Zillow, and I might get into it before the end of the show. But real estate markets are local. In other words, the Houston, Texas market tends to operate independently of the Washington, D.C. market, which operates independently of the San Francisco, California market, which operates independently of the Des Moines, Iowa market. Are you getting my point? Because here's the other thing. $362,000 price for a house. Well, I'll tell you what, that price point, it means something completely different in different places. How do I know this? Well, I've lived in different places. I will tell you that a $362,000 house in California is probably going to be on the closer end to maybe entry-level housing that's maybe a little tired and worn out, probably not necessarily new product, although it could be depending on geographic area. And then you compare that to, say, San Antonio, Texas, where $362,000, I'll buy you a really sweet house. I'm telling you, that's going to buy you a really sweet house. So, having said all of that, here's the final thought before we go to break. Don't worry about what all these articles are saying. Understand what they're trying to share with you. More about that when we come back.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. All right. So, you know what? I'm going to get into an article that was published on Zillow. As a matter of fact, it's an article that Zillow published, and it's the exact same author as the last article. Yeah, it's Lance Lambert. Yeah, this time he was published in Zillow. Now, I will tell you this, that the articles themselves are about 10 days apart. And it's kind of a follow-on. I guess if I were Lance Lambert, I'm not, but if I were that guy, I would be looking at this article as okay, what's happened in the last 10 days? So he had published information about what the Mortgage Bankers Association was predicting for house prices out there, right? Okay. Well, Zillow, not to be outdone, because Zillow, in Al's opinion, thinks that Zillow controls all real estate in the world, but that's just Al's opinion. It's also an opinion that I got from Mike Harrison, one of my fellow real estate investors, who also does the Lifestyles Unlimited Real Estate Investor Radio Show. You get the opportunity to hear Mike on Mondays. And I want to say about 2 weeks ago, he did an article that talked about why Zillow they were getting out of the home buying and renovation business, because what they found was that even though they are very, very good with doing modeling for apps or whatever that stuff is, what Zillow wasn't good at was breaking all of that data down based on market demographics. See, that's my point. That is my point, that real estate is local. You have to look at it from a local perspective. If you're going to invest in any market, make sure you understand the fundamentals regarding the economy in that local market. Very important. It's okay to go into a locality that maybe is depressed if the economic indicators are telling you that things are turning around, that locality is going to bounce back. If that locality is in decline, you don't want to invest there. You don't want to invest there, because what that tells me is that there will be more and more units available for less and less people, because they're all moving away. So you really have to have the best product at the best price to attract the best people. Yeah, That's what I'm saying. So let's get back to Zillow. Let's get back to Lance's article. So this article says Zillow changes its 2022 real estate outlook. Yeah, they changed their outlook. So earlier in the year, back in September, Zillow released their 2022 forecast, and they predicted that the U.S. home prices would climb another 11.7% over the coming 12 months. Yeah, so essentially what they're saying, from September of 2021 all the way until September of 2022, they anticipate U.S. home prices would go up by about 11.7%. Now, obviously, that number is a little bit different than what I just told you from the Mortgage Bankers Association. Part of that might just be they're measuring two different periods of time, okay? But here's the big takeaway. Both of these sources believe the values are going up. That's the big takeaway. But here's what Zillow did. Last week, Zillow actually went back and they changed their forecast. They actually changed it to say that they believe U.S. home prices will climb 13.6% between October of 2021 and October of 2022. That's a pretty significant increase, isn't it? Now, while a 13.6% would count maybe as deceleration from current levels, because we're actually seeing higher increases in today's markets. We actually are. Prices. I'm talking about what people have been paying. Prices went up 19.9% when it was measured from August of 2020 through August of 2021. Okay? So, I mean, that's the kind of crazy price appreciation, market appreciation, nothing that we as investors created. That's the crazy appreciation that's been going on out there. 19.9%. But Zillow still came back and they still jumped their prediction from 11.7 to 13.6. Okay, I'm not worried about who's right. I'm not worried if Zillow's right. I'm not worried if the Mortgage Bankers Association is right with their 15.3% prediction. They both believe it's going up. And I believe that too. I believe pricing is going up. I believe pricing is going up, and I believe there's a lot of reasons for it. Some of those reasons I've already highlighted on the show. I'll use the inflation word again, okay? Inflation is causing pricing to go up. Inflation is affecting the costs of goods and services in this country, and people will ultimately wind up being forced to pay more for those goods and services than they have before due to inflation. We've also had all of these artificial constraints put on all the different markets that are out there. And as a result of that, these artificial constraints, as they start to come off, are starting to allow the markets to get back to where they're supposed to be. I truly believe that's what's going on. I believe that the markets control their own destiny. I don't believe that George Soros does, although he might try. I don't believe that Warren Buffett does, although he might try. I don't believe that those guys necessarily control the markets 100%. They just don't. They can't. The market is too big. So, if you believe all of this information that I shared with you today, if you believe that real estate pricing is going up, that the future value of your asset will most likely be higher than the current value of your asset, the question I have for you is, why are you not investing in real estate? Why are you still doing what you're doing now, stuffing money into a 401k or an IRA or wherever you're putting your money? Maybe you've got it in gold, silver, I don't know. Maybe you listen to Robert Kiyosaki lately, and that's what he's been telling everybody to do. Because Kiyosaki, of all people, he thinks the market is overinflated. He totally thinks the market's overinflated on the stock market side. And I will tell you, I have found a lot of evidence out there that actually supports Kiyosaki's opinion. I actually found a lot of information out there. So what do? Well, the first thing I think you need to do is cool your jets. Yeah, cool your jets a little bit. Because after all, if you're not investing in real estate right now, you're not going to be invested probably in the next 5 to 10 minutes. Yeah, chances are you're not going to be invested in the next 5 to 10 minutes. And if you've been doing what you've been doing with the stock market for so long, chances are anything you do in the next 10 minutes isn't going to change whatever you're doing in the stock market. Okay, so we can agree on that. Good. The first thing I want you to do, I want you to come check out Lifestyles Unlimited. I'm sincere about that. I want you to look into how we buy, renovate, and operate residential income producing real estate. We'll show you how we do it. We'll spend an hour and a half with you, taking you through our free workshop where we lay everything out for you. When you're done with the workshop, you essentially have the framework for the roadmap to success that all of our members follow. At the end of that workshop, we're going to ask you if you want to become a member of Lifestyles Unlimited. And it costs a little bit of money, but it's not a terrible amount of money to become a member. Once you become a member, the thing you need to do is go through our Financial Freedom Workshop. Yeah, it's actually a seminar. It's 16 hours of education. We peel back the onions. We talk to you about what you're doing currently for retirement. We talk about what you need to be doing currently for retirement. We show you how to buy single-family properties. We show you how to buy multifamily properties. We talk to you about all the different ways you can invest in those different modalities. And then we turn you loose. We turn you loose on the world to go do the good things that you've learned how to do. And here's the nice part of being a Lifestyles Unlimited member. You have a support system. Yeah, there's a support system there. It's not just the educational piece. Del Walmsley figured out a long time ago that he could teach you how to do this, but if you didn't have all the other elements, you may not be successful. So Del wants you to be successful. He wants you to change the direction of your life. If you're willing to do this, I know it's Thanksgiving, but if you're willing to do this, go to lifestylesunlimitedworkshops.com. Sign up for a free workshop, and let's get you started. And happy Thanksgiving.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.